This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Hey, brother, I just finished listening to your July 5th episode. Man, I just absolutely love your content, man. It gives me value every time I listen to it. It gives me a different perspective on how I view some of the stuff that I do. It's just always good, man. And I want to keep telling you the same thing over and over and over. It does affect people. It does change people's lives. And really do appreciate all of the effort that you're putting into that, because I know that you really got better things to do than this, but yet you still sacrifice that time and do it. So hats off to you, bro.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Greetings, empowered investors, and welcome to episode 2201. And I am coming to you from the good old United States of America for a change. Back home in the US of A, and we are going to have a good show for you today. We've got a returning guest back on the show. That is none other than Robert Helms, and here he is. It is my pleasure to welcome back Mr. Robert Helms, the real estate guys. He is back with some news. We want to talk about refinancing. We want to talk about strategy for this market that we're in, and probably a whole bunch of other things, because our conversations tend to go deep. So Robert, welcome back. It's good to see you.
Well, thanks for having me. Always good to have conversations about real estate.
Yes, absolutely. So you were talking to me before we started, Robert, a little bit about refinancing. And we currently have the lowest mortgage rates in 15 months. A lot of people are breathing a big sigh of relief, and they love that. Of course, it's not as low as the COVID era rates, which were an anomaly to say the least. But what do you think?
Well, I do think a lot of news came out in the last week about refinancing being up 35%, meaning new applications for refinances were up, and over 100% from a year before, which is not that surprising given what the rates were a year ago, right? So I think you have to delve a little below the headlines. I must have read 6 or 7 articles that all just basically said, hey, everything's great, rates are down, so people are refinancing. But you have to get to that next level of understanding. And I think one of the big things is who specifically is refinancing. You know, you and I both talked about the fact that people that have a 3 or 3.5 or 4% loan might be making different decisions today. If I'm a home owner and I have a 3.5% rate, I don't have a lot of reason to refinance at 6 or 5.5 or 7. It's if I'm deciding I need to move. And sometimes that's because it's just that time. The kids are getting bigger, or we're having another one, or maybe it's my job has moved, so I'm going to have to move. And those folks were basically hostages to buy new houses when the rates were 7.5%. So I think we're now seeing rates at a point where the folks that bought a year ago are refinancing. And we've both been through the markets long enough to see there was that time period a few times where it's like every day you wake up, have a cup of coffee, refinance the mortgage, right? Because rates continue to go down. Well,
I love that line. Wake up, have a cup of coffee, refinance the mortgage. That's funny.
But there's another big thing people forget. And that is that every time you refinance, you start your amortization clock over. So when we borrow for 30 years, right, we're paying a whole bunch of interest in those first payments. And if we kept the loan 30 years, the last few payments, almost all principal. Well, the first 5 years is generally interest you're paying, and you're not paying the mortgage down very much. And that's when most people refinance and start that clock over. I'm not saying you wouldn't want to refinance for a better payment. People do that. But I do think that when we look at this big increase in refinances, you have to ask, well, your question, compared to what, right? There are more refinances than there were, but how many refinances were there a year ago?
Yeah.
Not very many.
Right. I'm going to give a very rough back of the napkin estimate here. Okay. And let's talk about those numbers a little bit, kind of look at them this way if we can. So we got about 140 million housing units in the United States. We've got maybe, since sales volume has been down so low, we've got maybe 10 million, give or take, that have transacted since the rate hikes. I'm going to put it about there. Maybe it's 9 million, a little less than 10 probably. So that is the number of people that would be kind of eligible, if you will, for refinancing, because they now can get a lower rate. Well, many of them can get a lower rate, not all of them, than they currently have. And they're only going to extend their amortization by 1 year or a maximum of 2 years.
Yep.
And that interest, because you pay mostly interest up front in an amortized loan, and then principal about 18 years in, you flip over to paying mostly principal. So that interest is deductible. So it's not that bad to pay it because the government's your partner, and depending on your tax bracket, maybe they're paying 40% of it for you, right? But everybody else, the tens of millions of people, they're not refinancing. Now, if we do finally see a pivot and some significant rate cuts, it's going to unleash a refinancing boom. All the mortgage people are going to love it. They're going to quit their jobs as the barista at the coffee shop or delivering pizza, because that's what they've had to do the last couple of years.
Less Uber drivers.
Yeah, or being Uber drivers, right? And they're going to go back into the mortgage business and make a fortune until the next cycle. What I mean to say there is the mortgage business is extremely volatile because it's very rate sensitive if those mortgage people are running their business based on refinance business. But still, we've got the lock-in effect. That's essentially what you're saying, right?
Yep.
Even with the mini refi boom we're going through, that only really covers the people that either absolutely had to move or the people that bought within the last, or refied within the last, I don't know why you refi, but in the last 2 years.
Yeah, no, I think that's exactly the case. And, you're right. If we continue to see rates go down, every incremental decrease is going to be more people that have a reason to refi. It may be these same people again. It may be the folks that bought at the 6% rate and now rates are 5%. So the math starts to make sense. That's a simple math equation, right? What is it going to cost me in points and fees to refi versus the time? Most people don't calculate the amortization. But to your point, a year, it's not that big of a deal. It's when you start refinancing at 5, 6, 7, 8 years in and go, wow, I'm resetting my clock. So there's strategies there, like maybe going from a 30-year to a 15-year. But the basic premise is, as real estate investors especially, we think differently than homeowners. A homeowner has that locked-in effect. An investor is going to buy a property if the numbers make sense. It's not about what's the absolute interest rate I'm paying. Right. It's how much cash flow can I create? How much equity can I build? How much investment capital do I have? And then do the rates work for that? And if they do, then it's a yes. And if they don't, well, we try not to get emotionally attached.
The investors also, though, they're evaluating not just that deal today, but they're looking at the overall housing shortage situation, which, by the way, I think we can all agree has been proven to be a real thing.
Yeah.
You see these people on YouTube out there saying the housing shortage is fake news and all this stuff. They're out of their mind. I mean, they've been talking about a crash for 4 years and the complete opposite has happened. Prices have gone up and up and up. And even with this incredibly kind of frozen market, we're still seeing prices rise. It's shocking to some people. Now, there are a few markets, by the way, one of which you're in, where you live in Dallas, Texas, and inventory has been definitely building in Texas and in some Florida markets too. Do you think that's a sign of a shift? And what's interesting about this, by the way, let me give you a little more meat to chew on that one. A lot of people are saying that some markets are even back to their pre-pandemic levels in terms of housing inventory. But what they're not saying is the pre-pandemic market, if you look at fall of 2019, for example, that was not a bad market. That was a fine market. I was making lots of money at that time. I mean, it was fine with me.
Yeah.
Now, if you go all the way back to 2011, I wasn't so happy. Even the pre-pandemic levels are not even a normal inventory level. Thoughts?
Yeah, so I think there's a couple things there. There's been a big move into states like Florida and Texas. And if we just watch jobs, if we just watch population, and we see reasons for that. And of course, you look where those people coming from. Well, a lot of people from California. Now, some of the Californias made it as far as Nevada, some made it to Arizona, many made it to Texas, and a few made it to Florida. But of course, East Coast folks, Chicago and New York and Massachusetts, those places, they definitely have looked at the Florida markets. Well, my premise is that there's only a certain number of available people who would consider moving, say, out of California into Texas for all the reasons.
Mm-hmm.
Not everybody has the same reasons, but I think that group of people has pretty much run its course. And so all of a sudden, we've got a situation where because prices have come up and interest rates have come down a little, a person that wasn't thinking about putting their home on the market a year ago is saying, you know what? We've got a lot of equity. We don't need this big house. Let's put it on the market. And, driving around anecdotally, that's what we see is we see homeowners who are putting their homes on the market, who have been there quite a while and probably have a very low LTV on their mortgage and are like, well, if I sold now, I could pocket $1 million. Why not do that with all the uncertainty and everything going on? So I think there are folks. My next door neighbor has their house for sale. Now, it's not a rental house, but it's been for sale now for 3 months. That's the longest listing I've seen in this neighborhood in years.
Yeah. Yeah, no, it's definitely an inventory build. And it's not, what's interesting about that is mostly when you see properties sit on the market for a long time, you're going to start to see overall marketplace price declines.
Yes.
And it's interesting because this market is like a standoff between buyers, sellers, and the Fed. I'd say it's like a three-way triangle standoff, really.
Yeah.
And, everybody's waiting for someone else to blink. And usually this would be prices coming down significantly. But yet, in most markets, prices are still rising. Thoughts on that?
Yeah, I do think that's true. And part of that is, as you've been talking about for the last year, inventory has been down. So who's had their home on the market? The folks that have had to, or for whatever reason, made the decision that I guess we have enough equity, we should try to sell. It's not the classic move-up buyer. Right. It makes sense for when a market's going up and interest rates are strong. Hey, that's a time to consider moving up, moving out of my $300,000 house into a $500,000 house. And that works in my favor. But not so when rates are where they are today. So what we are seeing is because there has been less supply and a decent amount of demand. Demand has been lower, but not quite as low as supply. So we have seen prices edging up. All of a sudden, there's markets where the opposite has happened. And it's pretty simple to go and look at the markets that have increasing inventory and see what happens to the price. There's always that anomaly, the place where it seems like inventory is growing and prices are still going up. But that doesn't sustain for too long. So I do think we're starting to see, right, all the margin markets, we're starting to see where there is real demand. And the inventory overall is not back to quote unquote normal, but getting there, every day. And then just the absolute reality of what it costs to afford a home today. Just with the interest rates they are now, it just that whole, buy rent scenario where a typical, employee would look at, does it make sense to buy a house or rent a house? Right now, rent is the answer for a lot, which as a landlord, I'm fine with.
Yeah, right, because it's a upward pressure on rents for sure. Okay, so Robert, I want to switch gears and I want to ask you about this proposal, which I think is just absolutely silly, from candidate Harris. Okay, she's saying, well, let's give everybody 25 grand to go out and help them buy a house, right? And this so reminds me of Obama's Cash for Clunkers program, because that was such a disaster. It was an absolute disaster. All it did is push used car prices through the roof. Why are these politicians so dumb that they don't understand the two sides of the equation here, supply and demand? They want to increase demand where we already have enough demand. We just don't have enough supply. They should work on supply. Reagan was coined as the guy behind supply side economics. We need to concentrate on the supply side, not the demand side. But, what do you think is going to happen here?
Yeah, it's so interesting to watch politicians try to come up with solutions for real world problems. It's like price control. When in the history of Earth has price control ever worked? It doesn't work in rent control. It doesn't work anywhere.
Yeah.
But because, and this isn't to be political, I would say this about almost every politician. They've never operated in the real world. They've never had to meet payroll. They aren't business people. You wouldn't expect them to have the knowledge base or the wisdom to really follow what would make sense. I will say this. I have seen programs for first-time buyers work successfully. California years ago had a program that got more people to buy homes. Now, it was not by lowering the standard. That happened later, but it was by an incentive and also a lender that would make a higher LTV loan.
Or
So
those Chaffa loans? Is that
like
what
the
you're
Chaffa
referring to?
loans,
Yeah.
right?
Okay. Yeah.
Yeah, so that was a program that worked. What it wasn't was free money.
Right.
My concern is if your idea of making home ownership more affordable is to hand someone 25 grand, all that money is going to end up in the hand of the seller.
Yeah.
That's not money that's really going to help the buyer. And it's going to have an effect on neighborhood prices, which actually puts affordability a little more out of reach. Like every time you try to finance something, you try to make student loans because that makes education more affordable. But as we know, it has the exact opposite effect. When you only have to pay $800 a month for that beautiful brand new car, it makes the car less affordable. So
Right.
I like the idea of trying to come up with a program that would get more buyers into the market. I don't think handing out free cash is the answer.
Yeah, well, how about just increasing the supply of homes? And by the way, people hear me say that a lot on the show, and I want you to know that that is against my interest that I'm saying that. Okay, like
Right.
I own homes, I don't want them to increase the supply. I mean,
No.
if I just want to be greedy, okay, I'm going to say don't build anything. Okay, don't build anything and give every buyer $25,000. In fact, give them $200,000 to help them buy a house because that'll just push the prices up to $200,000. Give them free money to rent houses too. That'll push the
Yeah.
rents up.
Right.
Okay,
Then the money ends up in your pocket. No, I
that's
hear you.
in my personal interest and your
Right.
personal interest and our client's personal interest. But I'm trying to say, let's solve society's problem here of housing affordability.
Well, and imagine that we took that $25,000 and instead created an incentive for builders to bring properties to the market that were affordable,
Yeah, right.
whatever that looks like. It addresses the supply side
Supply
and
side.
demand. We always talk about supply and demand, but the real estate guys, we talk about a third element, which is really part of demand. It's baked in, but it's what we call capacity to pay. So I have a demand. I want to own or rent a house, but do I have capacity to pay for that property? And with interest rates where they are, less people have that capacity. Part of the reason we've seen an uptick in new construction purchases is because many of those builders have the ability to buy forward the money that they can use to create an incentive, a lower rate on those mortgages. And you've got folks like that in your world. And so that's a real decision. I could buy a resale house and pay 6.5%, but gosh, that new builder, boy, brand new house, 4.25%. Well, builders can do that, whereas my neighbor next door can't.
Yeah, it's just outlandish. Some of these programs, I mean, all they're doing basically is it's like guaranteeing student loans. They're just going to make another tidal wave of money come at the market, and sellers will sit there saying, hey, there's more demand. I might as well just increase my price until the demand falls off. That's the way every market works. Yeah, absolutely. What are you working on at the Real Estate Guys? What are you thinking about lately, Robert? What's going on with you in your world?
Yeah, well, it's a great question. To your point, when we see there is less activity in general for investors for all the reasons, it's like, let's start thinking about ways that we can get exposure to real estate. We can get investment capital working in a marketplace where returns aren't what they once were. So we're spending a lot of time looking at what those alternatives are. Like you, I get asked to speak a lot, so I'm just in the process of putting together a couple of talks for some events coming up on this very topic. One of the panels that I know you're going to be speaking at Limitless with our good friend Ken McElroy. A panel I'm going to be moderating it is on emerging real estate opportunities, which is a pretty wide category. But I think there are some pretty unique ways to invest that can play into some of the realities of the marketplace instead of sitting on your hands. So many people
I think everybody's dying to hear those if they're not spoilers. But let us know. Give us a hint as to.
Well, I'll give you a couple of them. So one is one that you're very familiar with, and that is just not all markets are created equal. So if we take the premise that every day people are moving into and out of markets, there are obviously markets that have net in migration, but more than that, have room to run. That demand side is there. And then what does the supply side look like? So there's several markets right now where there's demand, there's good jobs, we're seeing payroll go up, but no one has stepped up yet to provide new housing inventory. So because of that, we get this constriction. And so those houses are selling for more. And in those markets, there may be an opportunity to either come alongside a builder or invest in a way that you can take advantage of the fact that it's not just that we need more housing, we need more housing in specific markets. Another example, we have a gentleman on the panel that you know well, who is in a non-real estate business, but this particular business has a voracious need for real estate, and that is parking. And parking hasn't always been a great investment opportunity because of the fact that you don't pay very much in most locations to park a car for the day. Now, that is not true near a stadium or in New York City, but in most cases, it doesn't pay very much. So those returns aren't exciting. A parking lot that's a paid parking lot is generally a way to land bank. But in this case, there's a big old company out there that needs to park a lot of vehicles, and they're strategic about where those vehicles need to sleep overnight. So there's opportunity there to look within the markets and find out, hey, where is there a demand that the rest of the world isn't seeing?
What are you talking about? The post office or
Amazon
cars that need to recharge? Oh, Amazon. Okay.
Amazon trucks need to be parked, and they need to be parked pretty close to the Amazon warehouse. And so our mutual friend Travis is going to be on my panel talking about that. He's a member of the Collective Inner Circle.
I had a feeling you might be referring to our friend Travis. The thing about that's interesting, though, is that those Amazon trucks don't sleep too long. Because,
no, they don't.
Now I'm seeing that Amazon, and they have delivered to me at 4 a.m. A couple times my dog caught them and barked, and I didn't like that very much. And they'll deliver till 10 p.m. So they're not sleeping too long. Okay.
No, they're not.
You have to
true. But they do need to rest. And of course, the big increase in the electric vehicles, well, they have to charge.
Yeah, right. Yeah, interesting. Good stuff. The last thing I want to talk to you about is institutional investors for a moment. Presidential candidate Kennedy has made an issue out of this. And although I like some of the stuff he says, I think he's very wrong about this institutional investor fear that he's mongering. Institutional investors really, they play a larger part than ever, as we both know, in the housing market. But in comparison to the overall market, they're minuscule. It's just not even a big deal.
Single digit.
Yeah, it's nothing big. But look out 5-10 years into the future. A lot more institutional investors owning single family homes, or about the same, or just what are your thoughts about them?
I think it's going to be more. I don't think it's going to be a lot more, but I'll tell you, I go to a lot of these conferences where these groups of professionals are. One of the conferences I've gone to for a long time, Single Family Housing Forum, every year, used to be mom and pop real estate investors that went. And today there's a few of those folks, but 70% of the attendees are suits. There are people from these funds and these institutions who are out looking for opportunity, a lot in the build-to-rent space, a lot in the individual rental homes. But I think that there's always a role for the institutional investor. Now, that's a pretty wide category. Mom and pop, we can be nimble, but it takes us time. We don't have that much capital. We have to study. We have to listen to awesome podcasts, and we have to go deploy our capital. Institutions can move so much faster. Now, even though they're faster, they aren't necessarily better. We saw a lot of institutions, overpay for houses. But at the end of the day, they're not emotional about it, right? They cut their losses and sell when they have to. So also institutions have always played a large role in commercial development, industrial development, even in agriculture. So I'm with you. I think there's room for it. I don't think that making those the bad guys is any better argument than saying, oh, it's the evil providers of all those things in the grocery store that are trying to rip you off by charging more money. No, it's that gas costs them more like it cost you more, and all those things move to the store in trucks. Their costs are up. Look at the insurance business. Everybody's freaking out about how high insurance costs are. But you know what's extremely low, lower than it's been in years? The profit insurance companies are making. It's not that they're trying to rip people off. Now, I'm no fan of insurance companies for a lot of reasons, but you can't point to them and saying they are greedy and they're making tens of millions on the backs of folks. It's just not true. And I think it's the same thing with institutional investors. Certainly there is the hedge fund that gets greedy and goes out and, pays the guy a $4 million bonus who doesn't deserve it. But in general, I think institutions aren't going away. And institutions are going to play a meaningful role in real estate for the foreseeable future.
I think it's really beneficial to mom and pop owners that the institutions are playing in the market. Yeah. And the reason is not just because they're gobbling up some of the supply, which, ultimately, pushes prices up, but they're also much better at raising rents. Now, of course, tenants don't want to hear this. Sorry, but this is just the market. I'm only reporting on it. Don't shoot the messenger. Every time I say this, I get all these negative comments on YouTube. People saying, "Well, what about us?" Right? Look, it's not my fault. I'm just reporting here. Okay, but institutional investors. The fact is, they're using rent optimization software, and they are much better at raising their rents than mom and pop landlords. And as mom and pop landlords, they're setting higher comps for you. So you should be glad they're in the marketplace. I mean, they're really helping you, okay, because you're kind of riding on their coattails. Robert, it's always great to talk to you. Give out your website and any final comment.
You can find us at realestateguysradio.com. I think the final comment is just investors always have a place in the market. And the fewer people that are pulling the trigger on deals, the less competition. So I congratulate people for listening to your podcast. They should continue to do that. You always have such awesome ideas. And I am looking forward to seeing you soon in person, my friend.
Talk to you soon.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.